Ashok Kumar Aggarwal, Academic Counselor, IGNOU. We are studying MMPC 016, International Business Management, Block 3, Strategies of International Business. What are the strategies of doing international business? Unit 9, Strategic Alliances, you see. Now, strategic alliances are voluntary agreements between two or more firms, you see. Suppose one firm is here and one firm is in USA to share between two or more firms to share capabilities, number one. Second, resources, then expertise, with the aim of enhancing competitive advantages or achieving mutually beneficial business objectives. Suppose one firm is in, you see, USA, one firm is, is in India. Now, strategic alliances are voluntary agreements, you see, between two or more firms to share capabilities, resources or expertise with the aim of enhancing competition advantages or achieving mutually, you see, beneficial business objective. The objective of both the firms these alliances can be local. Suppose you see within India, you see 2-3 firms join together, or global, you see one firm is in India, one firm is abroad, depending on the expansion and diversification plans of the organizations involved. They are particularly common in industries like, you see, auto components, you see, auto parts industries, then textile industries, then food processing, you see, industries. A notable example is the collaboration between, you see, Maruti, Government of India, Maruti, and Suzuki Motor Company, which successfully combined resources to dominate the Indian automotive market. Another example is, you see, BrahMos missile system, a result of the strategic alliance between India and Russia, you see, which has provided significant strategic and business gains for both the nations. The need for, now what is the need for strategic alliance? Why countries should do? The need for strategic alliance arises from various factors, including number one is risk sharing. You see, suppose they go in loss, so loss will be divided, you see, between two countries, you see, between the firms of two countries. Then economies of scale of action, then learning new skills, exploring new business opportunities and assessing restricted, you see, markets. Suppose one country, he is entering into that particular market and another country is not going to that market. Now, when they both together, you see, do the production, then naturally that product will be sold in that market. For instance, Apollo Hospitals, you see, alliance with Kenyatta National Hospital And second example is Airtel Africa in Kenya, exemplifies risk sharing and market expansion. Strategic alliances are defined as voluntary agreements between firms for exchanging, sharing or co-developing products, technologies or services. These alliances are business oriented collaborations aimed at gaining competitive advantage and extending ownership solutions. They can be broadly categorized into two types. First type is contractual alliance. These include co-marketing research and development contracts, turnkey projects, strategic suppliers, strategic distributors and licensing. Franchising. These alliances require lower commitments and have a limited scope. So first type is contractual. First type of alliances, contractual alliances. These include co-marketing research and development contracts, turnkey projects, strategic suppliers, strategic distribution and licensing, franchising. These alliances require lower commitments and have a limited scope. Next type of alliances equity based alliance, money, capital. These involve higher commitments and include strategic investments, cross shareholding and joint ventures. An example is a joint venture between Rolls-Royce and Hindustan Aeronautics Limited to manufacture parts for Adore engines under India's Make in India program. So next type of alliance is equity based alliance. These involve higher commitments and include strategic investments, cross shareholding and joint ventures. An example is a joint venture between Rolls-Royce and Hindustan Aeronautics Limited to manufacture parts for Adore engines under India's Make in India program. Our Prime Minister's Make in India program. Three key considerations that influence. Which are the three key considerations which are influencing these? Number one is industry based view. It focuses on collaboration among rivals, entry barriers and vertical alliances with suppliers or buyers. So first key consideration is industry based view. It focuses on collaboration among rivals, entry barriers and vertical alliances with suppliers or buyers. Second key consideration is resource based view. Industry based view, same industry, different manufacturers. Resource based view emphasizes the value, rarity, imitability and organization. VRO, VRIO. What is that? Value. R stands for rarity, I stands for imitability and organization. Framework to assess the potential of alliance. These four factors will assess the potential of the alliance. Third key consideration is institution based view. So industry based view, resource based view and third key consideration is institution based view. Considers formal regulatory frameworks and informal norms that shape alliance formation and operation. Now types of strategic alliances. How many types of strategic alliances are there? Number one is coalition, an alliance of competition, distribution and suppliers in the same industry. Suppose steel industry, pooling resources to gain a better hold of global markets. For example, the Star Alliance network in the airlines industry. So, the first type of alliance is coalition, an alliance of competitors, distributors and suppliers in the same industry, pooling resources to gain a better hold of global markets. For example, the Star Alliance network in the airline industry. Next is co-specialization. You see, partners contribute unique assets or competencies to develop new products or technologies. An example is the collaboration between India and Japan to co-develop fifth and sixth generation communication, you see, technologies, mobile phones. The next type of, you see, strategic alliance is learning alliance, formed for know-how transfers, particularly knowledge sharing. For instance, Honda's investment in General Motors autonomous vehicle unit, cruise automation, aimed at learning futuristic, you see, technologies. Next type of alliance is equity alliance, joint ventures where firms pool resources in a separate jointly owned organization. Next type of alliance is minority equity alliance, one partner makes a minority investment in another, often seen in high-tech industries like telecommunication and biotechnology. Non-equity alliances include licensing, joint research and development and joint marketing efforts without equity exchange. Now, so we have studied contractual alliance, we have studied equity based alliance, we have studied industry based view. You see, three key considerations that influence are, you see, industry based view, resource based view, then institution based view. Then types of strategic alliances are coalition, then co-specialization, learning alliance, equity alliance, then minority equity alliance, then non-equity alliance. Now, strategic values of alliances. The strategic value of alliances lies in their ability to create and capture value for the partners involved. The value created by an alliance can be, you see, assessed through revenues, you see, profits generated from sales volume or differentiated, you see, pricing, future revenues or cost benefits from joint research and development, then economies of scale, large, you see, large production and scope. You see, when you do production at large scale, your fixed costs will remain same, only variable cost like raw material, etc., labor will change, you see, will increase. So, strategic value of alliances, the strategic value of alliances lies in their ability to create and capture value for the partners involved. The value created by an alliance can be assessed through revenue generated from sales volume or differentiated pricing, future revenues or cost benefits from joint research and development, economies of scale and scope. Now, resource based considerations, you see, value added must outweigh cost, rarity of relational capabilities and desirable partners, imitability of firm specific and relationship specific capabilities, organization of alliance activities in the firm and relationship levels, you see. This is resource based considerations. Industry based consideration, collaboration among rivals, entry barriers scaled by alliances, upstream, downstream, vertical alliances with suppliers, buyers, alliance and network to provide substitute products, oblique services. Now, we have studied strategic alliance and networks, formation, evaluation, performance, you see. So, third is institution based, you see, considerations, formal regulatory pillar, informal normative pillar and informal cognitive pillar. Now, alliance management. Effective alliance management involves 5 key stages, you see. Number 1 is partner assessment, analyzing potential partners, you see, who are, by whom you will be benefited, strengths, their strengths, weaknesses and strategic compatibility. Then next is contract negotiation, defining objectives, contributions and legal structures. Alliance operation, ensuring senior management commitment and resource allocation. Alliance termination, winding up the alliance upon meeting or filling objectives. Implementation and management, addressing integration, cooperation and learning. Now alliance management, next is partner analysis is critical and include strategic fit, compatibility of partners objectives. Next is capabilities fit, that is complementary resources and value chain contributions. So alliance management, partner analysis is critical, partner analysis is critical, how to choose partners, how to analyze them, and which includes strategic fit, compatibility of partners, both the partners are compatible. Then objectives, what are the objectives of partners? Then capabilities fit, complementary resources and value chain contributions. Now cultural fit, alignment of corporate, industry and national values. Organizational fit, compatibility of structures, systems and procedures. So under cultural fit, alignment of corporate, industry and national values. Under organization fit, compatibility of structures, systems and procedures. Now negotiation and design, negotiation and design involve legal structures and decision making mechanisms, task integration and human resource issues, value distribution and conflict resolution mechanism. So negotiation and design will include legal structures and decision making mechanisms, task integration and human resource issues, value distribution and conflict resolution mechanisms. Now implementation focuses on integration, cooperation and learning. Partners can learn about the business, tasks and each other's expectations and capabilities, which is vital for long term association, long term success. So implementation is another area. Implementation focuses on integration, cooperation and learning. Partners can learn about the business, tasks and each other's expectations and capabilities, which is vital for long term success. Then now strategic alliances differ from mergers. They are not mergers and acquisitions. If you acquire any industry or if you are merged with some other industry, so strategic alliances are different from both these, in that they involve collaboration without loss of strategic autonomy. They are essential for firms entering new markets or industries, offering benefits like risk sharing and cost reduction and access to new technologies. If you are going for risk sharing, cost reduction and access to new technologies, then naturally you will go for strategic alliance. The success of an alliance depends on factors such as strategic fit, cultural alignment and effective management. Whether the alliance will be successful or not, it will depend on factors like strategic fit, cultural alignment and effective management. Now we come on the next unit, that is international marketing. International marketing involves the exchange of goods, services and ideas across national borders. Ideas from India, they go abroad. Ideas from USA come to India. Adopting marketing principles to diverse global markets. Unlike domestic market, it requires understanding economic, socio-cultural, technologies and legal differences between the countries. So international marketing involves the exchange of goods, exchange of services, exchange of ideas from one country to another across borders, adopting marketing principles to diverse global markets. Unlike domestic marketing, it requires understanding economic, socio-cultural, technological and legal differences between countries. The shift toward globalization has made international marketing, you see, essential, with production moving to low cost, you see, centers like China and India, leading to the internationalization of supply chains. So, the shift toward globalization has made international marketing essential, with production involving moving to low cost centers like China and India, leading to the internationalization of supply chains. Now, key drivers of international marketing are liberalization of markets, reduce, you see, trade barriers. Next key driver is, you see, tax advantage, that is from setting up in tax, you see, havens like Singapore. Then free trade agreements, that is European Union, Asian. Growth in, you see, market share expanding beyond saturated domestic markets. So, key drivers of international marketing are liberalization of markets, tax advantage, free trade agreements, growth in, you see, market share. Then technology and, you see, communication, that is the next key driver, e-commerce, digital platform, cultural exchanges, that is Indian products in Gulf countries due to diaspora. Then improved logistics, you see, faster, cheaper shipping charges, you see. These were the next, you see, key drivers. So, total key drivers are liberation of markets, tax advantages, free trade agreements, growth in market share, then technology and communication, cultural exchanges, improved logistics. Now, what challenges, you see, are there? Challenges are technological disruptions, that is e-commerce competition, global competition, local versus global brands. Naturally, if local is cheaper, people will go for local, you see. If there is huge difference between local and, you see, imported foreign good, then, you see, people will go for local. If there is little difference, then people may go for, you see, if it is little expensive, they will buy imported. Then consumer expectations, demand for quality, customization. Then regulatory complexities, you see, trade laws, tariffs. So, challenges include, you see, technological disruptions, global competition, consumer expectations, regulatory complexities. Now, example is, you see, domestic, a company selling tea in India focuses on local markets, local, you see, taste, they will see the taste of the local people, they will manufacture accordingly. International, the same company modifies flavors for the British, you see, or Middle Eastern, you see, markets. So, they modify the flavor for them because they prefer, they like, you see, those flavors. Now, what are the key differences between domestic marketing and international marketing? The first key factor is market segmentation. Under domestic marketing, single market with sub segments. Under international marketing, multiple markets with varying sub segments. The next point is market control. Under domestic marketing, easier due to uniform regulations. Under international marketing, complex due to cultural, legal and political differences. Then third point is product adaptation. Under domestic marketing, standardized for local preferences. You see, just now we saw the example of tea. And international marketing requires customization, that is McDonald's, you see, menus. Next difference is price strategy. Under domestic marketing, based on local competition and costs. Under international marketing, influenced by exchange rates, you see, rate of dollar changes, you see, tariffs and purchasing power. Next is purchasing power of the people of that country, you see. Next is promotion, you see, under domestic marketing, single message for the entire market. International marketing, cultural tailored campaigns, that is Coca-Cola's, you see, regional ads. Next point is distribution. Under domestic market, well established logistics. International marketing requires local partnerships, that is Amazon's global, you see, supply chain. Now, reasons for entering international market. Why do you want to enter international market? What are the reasons? Firms expand globally for profitability. Naturally, everybody is doing business for the earning profit. Higher revenue from untapped markets, you see, where there is scope, where that product, you see, not sold so far. So you can your sales will increase there, you see, and you can increase naturally more sales, more profit. Growth engineering markets, that is Asia, Africa, after expansion opportunities, offer expansion opportunities. Economies of scale, larger production reduces, you see, per unit cost naturally, because fixed costs will remain same, only variable cost like raw material, labor, they will change. So reasons for entering international markets are profitability, growth and economies of scale. Then next reason is risk diversification. Reduces dependence on a single economy, you see, two countries, two economies, access to resources, cheaper raw materials or skilled labor, product life cycle extension. A declining product in one market may, you see, thrive in another market. So other reasons are, you see, risk diversification, access to resources, product life cycle extension. Now PRG framework, international market, you see, orientation. Now this table is, you see, there are three columns: orientation, description, example. First, orientation on, you see, ethnocentric, you see, description is home market strategies applied globally with minimum you see adaptation. Example is, you see, Patanjali selling Ayurvedic products globally without major changes, same products are there. Next is polycentric, you see, tailored strategies for each country. Apollo hospitals customizing services for Middle East versus via, you see, versus Africa. Third is regional centric strategies designed for a group of similar countries, that is, you see, your EU, ASEAN. Example is Mahindra setting up regional hubs in Africa and the United States. Next is geocentric, you see, truly global approach with standardized, you see, locally adaptable strategies, yet locally adaptable strategies. You see, truly global approach with standardized, yet locally adaptable, you see, strategies. Example is, you see, Unilever, Hindustan Liver. Global strategy, you see, global brands, local, you see, flavors. So we have studied, you see, ethnocentric, then polycentric, then region centric, then geocentric, you see. Now modes of entry into international markets, you see, export import, basic trade, that is, you see, Coromandel, you see, international exporting pesticides, you see, this is the example. Coromandel, you see, international exporting pesticides. Then subsidiaries, you see, fully owned foreign operations, that is Coca-Cola India. Joint ventures, that is shared ownership, that is, you see, BrahMos, Aerospace, India and Russia. So modes of entry, we are studying export import, you see, then subsidiaries, you can have a subsidiary there, then you can enter into a joint venture with a foreign company. Then franchising, next, that is another, you see, mode of entry. Local partners run operations, that is McDonald. Then licensing, allowing foreign firms to use, you see, IP, that is Mahindra, Renault, you see, partnership, making cars, you see, cars. Then next is strategic alliance, you see, by this you can enter. Collaboration without equity, that is TVS, BMW for electric bikes, example. Then greenfield operations, building from scratch, that is Samsung's, you see, Noida plant. Now international consumer behavior varies due to cultural factors, that is religion and traditions, economic conditions, purchasing power, inflation, you see, how much is your income, you see, purchasing power. Then legal and political environment, you see, trade laws, stability, government is stable or not. Then technology and infrastructure, e-commerce, penetration, logistics. So consumer behavior, you see, depends, varies, you see, due to cultural factors, that is religion, traditions, you see, everybody follows his or her religion, traditions, his or her traditions, then economic conditions, purchasing power of the person, then inflation, legal and political environment, you see, that is trade laws, stability, technology and infrastructure, e-commerce penetration and logistics. Selecting international markets and distribution channels, you see, market selective criteria, economic growth rate, political stability, competition, legal barriers. Example is a tech firm may prioritize the US and EU over restrictive, you see, markets. Selecting international markets and distribution channels, you see, distribution channels, export consortia, then canalizing, you see, agencies, export consortia, group of firms collaborating, that is textile exporters alliance. Next is, you see, canalizing agencies, government designated exporters, that is MMTC for metals, MMTC gold, it is exporting, you see. Then selecting international markets and distribution channels, next point is merchant exporters, third party traders, then direct exports, selling straight to foreign buyers, you see, you will have higher profit but risk will be more. Then overseas sales agents, you see, local representatives handling, you see, sales. Now steps for successful exporting are, you see, obtain IE code, importer, IE means importer exporter code from DGFT, register with Export Promotion Council, that is April Export Promotion Council, identify buyers, trade fairs, directions, digital platforms, you see, search for buyers, negotiable contracts, pricing, terms like free on board, you see, cost insurance freight, arrange logistics, shipping insurance, custom clearance, shipping bill of lading, documentation, you see, commercial invoice, certificate of origin, payment realization, letter of credit, you see, bank realization certificate. Now what is letter of credit? You see, suppose your buyer is in America, you are manufacturing here and, you see, sending say 10,000 shirts to a firm in America. Now you are not sure whether you will get the money or not. So before meeting out the order, you ask the buyer to send one letter of credit. In that letter of credit, buyer's bank will write that if the order is met as per the, you see, terms and conditions mentioned, we take the responsibility of payment. We will make the payment if the importer does not make the payment. So then naturally after receiving this letter, your bank will receive this letter, and when you know about it, then you will start manufacturing, and you know that your money is safe, your money won't go anywhere. So you have to give good quality, and as per the order you have to meet out everything. Next is claim export benefits, you see, duty drawbacks, you see, then tax refunds. If you are an exporter, you will be, you see, charge less tax. Secondly, you will pay, so many incentives are there, you see, you will pay, you see, by the government. Now international marketing requires adopting to, you see, diverse markets. Firms enter global markets for growth, risk diversification and economies of scale. For growth, you see, more production, more, you see, to become big firm, you see, then risk diversification, risk will be divided, and then if the production is at large scale, naturally cost price will be reduced. Then entry strategies range from exports to, you see, joint ventures and subsidies, you see. Consumer behavior is shaped by, you see, culture, economy and regulations. Successful exporting you see involves meticulous planning, documentation and compliance. You see. So, consumer behavior is you see shaped by cultural, economy and regulations. Successful exporting involves meticulous planning and documentation and compliance. You see. Now, what a exporter in India, you see, what points he should you see take into in his mind. First point is you see requirements are mentioned in the order. You see what the buyer wants. So you have to you see manufacture exactly you see same. You should not compromise in the quality. You see whatever you see sample you have sent and those samples approved. So same material you have to use for meeting out the you see order. Then your payment won't go you see because you will have a letter of credit also. You see if the order is met as per the points mentioned in it, you see your payment will come. You see bank takes the responsibility of making the payment. But you see you also manufacturer or the exporter, he should also not you see give any inferior type of goods or some you see say 80% good quality of goods, 20% inferior type. No, you see 100% you see you have to meet out the order as per the requirements. Now we come on the you see third unit, that is international finance. You see from where to get the you see money. You see international finance is a critical field you see that examines the dynamics of exchange rates, dollar, what is the rate of dollar, foreign investment you see and their impact on global trade. You see it encompasses various aspects such as exchange rate mechanism, capital flows, trade deficits and surpluses, and financial instruments like forwards you see futures and swaps. So international finance is a critical field that examines the dynamics of exchange rates, foreign investment and their impact on global trade. It encompasses you see various aspects such as you see exchange rate mechanism, capital flows, trade deficits and surpluses, and financial instruments like futures, forwards and swaps. Now why this exchange rate? Suppose you see 10,000 shirts you have you see exported. Today say dollars rate is 100 rupees per dollar, $1 is 100, example, it is example. So 10,000 into 100, you are thinking that you will receive this much, but you see by the time the shirts reach there, that person makes the payment. You see you have to consider the rate on that day. If suppose there on that day rate is you see $1 is equal to 90, so your profits will you see reduce. Instead of 100, if it is 90, you see your profits will reduce. Now key drivers of globalization in finance, you see reduced trade barriers, you see tariffs should be reduced, quotas should be reduced, technological advancements, you see digital banking and blockchain, then integration of financial markets, that is cross border you see mergers. So key drivers of globalization in finance are reduced trade barriers, technological advancements, you see integration of financial markets, global financial system. The global financial system consists of institutions that regulate and facilitate you see cross border financial transactions. Key players include you see the International Monetary Fund, IMF, which provides loans to stabilize you see economies and monitors global finance stability, as seen during you see Greece's 2008 you see crisis. So the global financial system consists of institutions that regulate and facilitate cross border financial transactions. Key players include the International Monetary Fund, which provides loans to stabilize economies and monitor you see global financial stability as seen during Greece's 2008 crisis. The World Bank funds develop projects such as infrastructure in Africa, while the World Trade Organization WTO ensures fair trade practices and resolves disputes like the US EU Airbus subsidies case. A notable tool in this system is the IMF's special drawing rights SDRs, which act as a reserve currency for member nations, providing liquidity during economic crisis. So, the World Bank funds development projects such as infrastructure in Africa, while even in India also so many projects, World Bank's projects are going on, where the World Trade Organization's WTO ensures fair trade practices and resolves disputes like the US EU Airbus subsidies case. A notable tool in this system is the International Monetary Fund special drawing rights, which act as a reserve currency for member nations, providing liquidity during economic crisis. International monetary system. The international monetary system has evolved significantly over time. The classic gold standard 1821 to 1914 pegged currencies to gold, ensuring stability but limiting money supply and causing deflation. Now say for example 10 grams of gold during 1821 to 1914 this was followed. 10 grams of gold is equal to so many rupees in India, so many dollars in America and other currencies, other nations. So all those will be then equal. Suppose 10 gram gold is causing in India say 1 lakh rupees, and in America it is causing $9,000. So 1 lakh rupees is equal to 9,000 dollars. So you can find the rate of $1 like this. Now next is the Bretton Woods system 1944 to 1971. It replaced this by pegging the US dollar to gold and other currencies to the US dollar. However, it collapsed due to US inflation from the Vietnam War and resistance from countries like Japan to USD depreciation. So the Bretton Woods system 1944 to 1971 replaced this by pegging the US dollar to gold and other currencies to the US dollar. However, it collapsed due to US inflation from the Vietnam War and resistance from countries like Japan to USD depreciation. Now, introduction to monetary system. Since 1971, the world war has operated under a floating exchange rate system where currency values fluctuate based on market forces. This era has witnessed crises like the 1997 Asian financial crisis, currency devaluations, and the 2008 subprime crisis in global liquidity crunch, highlighting the need for robust monetary policies. So now international monetary system in 1971 the world has operated under a floating exchange rate system where currency values fluctuated based on market forces. This era has witnessed crises like the 1997 Asian financial crisis, currency devaluations, and the 2008 subprime crisis, global liquidity crunch, highlighting the need for robust monetary policies. Now international flow of funds, balance of payments. Suppose we do more exports, will get more dollars, you see. So, if you will, you see, subtract from exports, imports, you see, if imports are less than exports, then you see it is good. Our balance of payments will always have dollars, you see. So, the balance of payments is comprehensive record of country's economic transactions with the world. It includes the trade account, that is goods, exports and imports, then current account, services and remittance, then capital account, you see FDI, loans, and financial account, you see change in reserves. So, the balance of payments, BOP, we write in short, is a comprehensive record of country's economic transactions with the rest of the world. It includes the trade account, goods, exports, imports, current account, services, remittances, and capital account, you see FDI and loans, and financial account, changes in reserves. Now, you see balance of payments, record of economic transactions between a country and the world, component, description, example. Trade account, you see goods, exports, imports, example is India's software exports to the US. Current account is services, tourism, remittances, unilateral transfers, Indian workers remittance from UAE. Then capital account, fixed deposit investment, FDI, portfolio investment, loans, Toyota's factories investment in India. The next is financial account, changes in foreign reserves, that is gold, special drawing rights, RBI's US dollar reserves, you see management. The forex, you see market facilitates currency exchange and is divided into the spot market, immediate transactions of current rates, forward market, future contracts to lock in rates, you see, and derivatives market, futures, options and swaps. Major participants include commercial banks, you see, for example, Hong Kong, Shanghai banking corporations, then corporations hedging, you see, foreign risks, and central banks stabilizing, you see, currencies. So, central bank is the bankers bank, in our country Reserve Bank is the central bank. Similarly, you see every country is having a central bank. So, foreign exchange market, you see major participants are, you see commercial banks, say for example in our bank, you see State Bank, then Bank of India, Punjab, Union Bank of India, Central Bank of India, Bank of Maharashtra, then Punjab National Bank, then if you will go to South Indian Overseas Bank, Indian Bank, Vijaya Bank, then you see many banks are there, you see in our country. So, they all participate. Then corporations, HSBC, foreign banks also you see participate. Then corporations hedging forex, you see risk, and central bank stabilizing currencies. The role of central bank is, you see, stabilize the value of currency. Each country is having a central bank, bankers bank, which controls the other, you see, commercial banks. Foreign exchange market, you see, forex. For example, an Indian exporter might use forward contracts to hedge against US dollar depreciation, ensuring predictable revenue. The forex market operates 24/7 with the interbank, you see, market serving as the core, you see, platform for large scale, you see, currency trade. So, an Indian, you see, exporter might use forward contracts to hedge, you see, against US dollars depreciation, ensuring predictable revenue. The forex, you see, market operations 24/7 with the interbank market serving as the core platform for large scale, you see, currency trades. Now, foreign exchange market key players are commercial banks, Bank of India, Central Bank, State Bank of India, in our country commercial banks. So, we will start from, you see, this Bank of India, then Union Bank of India, then Central Bank of India, then Bank of Maharashtra, then next is Punjab National Bank, State Bank is of course you see Bankers Bank, then we come on you see in South Indian Bank, Indian Overseas Bank, Corporation Bank, Syndicate Bank, Vijaya Bank, then you see we have seen banks of Bombay, head office in Bombay, then South head office, then Delhi head office, then Calcutta head office, United Commercial Bank, then United Commercial Bank, UCO Bank, then our you see Allahabad Bank, that is also in Calcutta. So like this you see commercial banks, they are the key player in foreign exchange market. Then corporations, you see their work is you see hedging, you see forex risk. Then next is central banks, you see intervention to stabilize currency. Why central banks are intervening? You see they want the currency you see should be stabilized. Now we come on the next example is an Indian exporter uses forward contract you see to hedge against you see US dollar depreciation. Now currency fluctuations pose risk to international business, you see necessitating hedging strategies. Full hedging minimizes risk by covering all exposures but offers low returns, while selective hedging you see balances risk and reward by covering only critical exposures. You see speculative strategies involve you see high risk bets on currency movements for you see potentially you see high rewards. So currency fluctuations pose risk to you see international business. Suppose you have exported 10,000 shirts today say $1 is equal to 100 rupees. When the payment will come say after 2 months, you see $1 becomes 90 rupees, so you will be the loser. So currency fluctuations pose risk to international business, necessitating hedging strategies. Full hedging minimizes risk by covering you see all exposures but offers low returns, while selective hedging you see balances risk and reward by covering only critical you see exposures. Speculative strategies involve you see high risk bets or currency movements for potentially high you see rewards. So currency fluctuations pose risk to international you see businesses, necessitating hedging strategies. Full hedging minimizes risk by covering you see all exposures but offers low returns, while selective hedging you see balances you see risk and reward by covering only critical exposures. Speculative you see strategies involve high risk bets on currency movements for potentially you see high rewards. Now tools like forward contracts, customize you see over the counter OTC agreement, futures, standardized exchange traded contracts and options, flexible rights to buy sell help manage you see these risks. For instance, Apple Inc. you see uses currency swaps to mitigate you see your you see Japanese yen, then euros volatility, protecting you see its profit you see margins. So tools like forward contracts, customize over the counter agreements, futures, standardized you see exchange traded contracts and options, flexible rights to buy sell help manage these risks. For instance, you see Apple Inc. you see uses currency swaps to mitigate euros Japanese volatility, protecting you see its profit margins. Now next is you see hedging strategies, you see strategy, then risk reward, then example you see strategy full hedging, you see risk reward, low risk low reward, you see example is hedging 100% exposure via futures. Then strategy selective hedging, you see risk reward is moderate risk reward, example is hedging only 50% of exposure. Third one is speculative strategy, that is risk reward is high risk high reward, example is betting on currency you see appreciation. Foreign investment comes in two forms, that is foreign direct investment FDI and foreign portfolio investment FPI. FDI involves long term investments like greenfield projects, that is Tesla's, you see, gigafactory in Germany, or mergers and acquisitions. So, foreign direct investment and foreign portfolio investment. Foreign direct investment, you see, involves long term investments like greenfields projects, that is Tesla's, you see, gigafactory in Germany, or mergers and acquisitions, that is Walmart's, you see, purchase of Flipkart. FPI, foreign investment. FPI includes, you see, short term investments in stocks, bonds, that is, you see, FIIs in Indian equities. FDI benefits host countries through job creation and technology transfer, that is Samsung in Vietnam, while home countries, you see, gain from profit repatriation, that is US firms in China. However, over reliance on FDI can be risky, as seen in, you see, Venezuela's oil department, you see, economy. Next is terms of payment in international, you see, trade. International trade relies on secure payment method, each will varying risk levels. Payment in advance is safest for exports but risky for importers, often used for high value goods like machinery. Letters of credit governed by UCPDC 600 rules. You see, balance risk by involving banks to guarantee payment upon document submission, that is letter of, you see, credit. Next is documentary collection, DP or DA. Documents against payment, that is DP. Documents against acceptance, that is DA. Offer moderate risk, while open accounts are risky for exporters but convenient for, you see, trusted partners, that is IKEA and its suppliers. Next is terms of payment in international trade. For example, an India farmer exporter might use a confirmed letter of credit to ensure payment over a new African buyer, reducing non-payment risk. Key terms are UCPDC 600 ICC rules governing letter of credits, SWIFT network for secure LC transmission. Now next is, you see, payment methods, risk to exporter, risk to importer. Example, payment in advance, risk to exporter low, risk to importer high, 50% advance for custom machinery. Letter of credit, risk to exporter medium, risk to importer low. Example, irrevocable letter of credit for textile exports. Documentary collection, risk to exporter high, documents against exceptions, risk to importer medium, documents against payment. Example is documents against payment for automotive parts. The next is open account, you see, risk to exporter is very high, risk to importer is low. Example is trusted partner, that is IKEA supplier. Now, international finance is a multifaceted field covering global financial systems, exchange rate mechanism, you see, risk management and trade payments. The IMF and World Bank play pivotal roles in maintaining, you see, stability, while the forex market enables, you see, seamless currency, you see, exchange. Balance of payment tracks economic health, that is hedging strategies protect business from currency risks. FDI and FPI drive global, you see, growth but require, you see, careful regulation. Finally, trade payment methods, that is like LCs and advance payments, ensure secure transactions. Understanding these concepts is essential for navigating the complexities of global finance, from mitigating risks to capitalizing on international opportunities. So, under summary, we have seen international finance is a multifaceted field covering global financial systems, exchange rate mechanism, risk management and trade payments. The IMF and World Bank, International Monetary Fund and World Bank may play, you see, pivotal roles in maintaining, you see, stability, while the forex market enables seamless currency exchanges. Balance of payment, you see, tracks a country's economic health, and hedging strategies protect businesses from, you see, currency risks. Say for example, you want to make the payment, you see, after 6 months, and the rate, you see, is decided now only. So, it is a very safe payment. So, FDI and FPI you see drive global growth, but requires you see careful regulation. FDI means foreign direct investment. When people invest in our Indian companies, you see, we pay them dividend, interest. Finally, trade payment method like letter of credit, you see, letter of credit, same we have learned, you see. The importers bank gives a letter to the exporters bank that if the order is met at as per the things mentioned in the you see agreement, we take the assurance of the payment, you see. If the importer will not pay, then we will pay on behalf of the importer. That is what is letter of credit. You see, finally, trade payment methods like letter of credit, they are very safe, and advance payments ensure secure transactions. Understanding these concepts is essential for navigating the complexities of global finance, from mitigating risk to capitalizing on international opportunities. So, students, we are closing this session. Thank you very much.